And then you'd get some sort of massive default cycle, which we're probably due for anyway on lots of other measures. But then you pick up the fact that when sovereign defaults occur, on average, historically, about 50% of that country's corporates default. It's a stat which I was staggered when I read it, but it is actually a real number. So the possibility of ending up with a massive default cycle is a real one. So how long do we keep drifting along, low interest rates, chucking money at those who can't pay their debts, trying to take it forward? Ireland's got something around about 200,000 euros of debt per taxpayer. Anybody in the room think they can possibly avoid default? Would you, if you were an Irishman, even vote for not avoiding default? You would definitely default. So this lot goes. Bit of behavior, though, for you. Let's try this on the audience. Which country in Europe has the lowest corporate bankruptcy rate? Come on, you're all experts on failure. Nobody. I'll tell you. It's Ireland. Second lowest? Greece. Third lowest? Portugal. Fourth lowest and fifth lowest toss-up between Spain and Benelux. Germany's way up there. Now, what have you learned from that? Head in the sand is a really serious issue. That's how people behave. Greece's bankruptcy rate's approximately 1/3 of 10 years ago. It has the worst bankruptcy rules pretty well in Europe, so if you ever get stuck into one, hard luck. But it is amazing that we've got this ignorance of problems. And the worse it is, the more likely we are, it seems, not to deal with them. The big elephant in the room is not being addressed. So all those countries are building up lots of companies that should have gone bust. That'll limit their growth. Their large states will limit their growth. All this lot just turns and turns and turns and drives you towards there will be a break in interest rates sometime. Then you move into the really tedious end of life. Regulation. It's getting more boring. It's definitely more intrusive in this trade. You've got the rating agencies being subject to some form of regulation from the EU. It'll be the usual gross overkill at some point, I'm sure. The alternative investment fund stuff, that affects a few of the CLO light vehicles. Dodd-Frank. Basel III, mostly good for the industry if it makes the banks impossible to operate and they haven't worked out that CLOs look like banks. Then you're going to be able to operate on better terms. I fear at some stage you're going to find some nasty little fellow from Brussels turning up and pointing out you look like a bank. So it could happen. Article 122A, need for more capital. SEC Rule 15GA2, requiring you to actually tell people if you've had a report saying it was a pile of junk 5 days before you sell it to them. Factor on the tax deductions. You've got the litigation, the type of Concord and B of A case. I suppose most of you know more about it than I do. But watching managers do things which the investors didn't expect to avoid OC problems. But CLOs are still a better structure than the bank on most counts. And there's really a need to grow non-banks, that's quite clear. The banking model is challenged in all kinds of ways, regulators, economically, investor, comprehensibility and management even now. Hardly anybody understands the accounts of a bank, including the people who run them. It's really getting quite difficult. So CLOs are in a good place. And if they are run properly and put together well, they could take a lot of share off banks over the years ahead. But you do need more discipline in the trade, possibly not all the regulation you've got on that page, and you're definitely going to get some more discipline. Anyway, with that, I'll shut up and invite any questions. The man was obviously looking for regulation. Any questions? Come on, somebody must disagree with me on something. Anybody? Come on. We've got one, brave sir.
You've always cautioned against too much leverage. What is the right amount of leverage
The answer is, of course, it depends on the times, and it depends on the nature of what the CLO does. 25% equity, doesn't get me twitching with nervousness. 10% certainly does. At 50%, making the arithmetic tie together is impossible pretty well. So it's going to be in that ballpark, but it's obviously a function of what you're going to stick in it. If you're going to stick in some Cov Light stuff, which, by the way, there's a nice article in the pack you've got today explaining that Cov Light's good for you, and you shouldn't worry about it. So I think optimism is definitely a return to the market. It explains there's no point in having covenants. So if you fill it with Cov Lights, I'd recommend quite a bit more equity. And another question, any kind? Yes, sir. Shout up.
Yeah, in your presentation, I get the feeling that you are sort of on the inflationist side of the party. But on the same... working? So looking at your presentation, much of what you say, I think, seems to point towards inflation in the future. But then on the other hand, what we know from history is that credit contraction, which is what we're probably facing over the next few decades, actually creates deflation. Yeah. So what do you believe is going to happen? Is it going to be inflation or deflation?
Short term, I don't know. You've got two different lots of credit activity going on, haven't you? You've got governments producing buckets of the stuff out of thin air to use on sovereigns. And you've got a banking system which is reducing credit for industry on the whole. How that plays out over time, I don't know. I don't know how long the sovereign setup can do. Those of you with the credit analysis bias, go and have a look at the balance sheet of the IMF. It'll horrify you. What's in the ECB? Both these fundamentally are nothing but printing presses. So in time, printing press always beats every other method of running an economy. So I expect inflation to come. But short term, it may very well be that the reduction in lending, credit contraction that comes out of that holds it in check for a while. But it's really very unstable because the levels are sky high. The UK is running twice the narrowly defined national debt and 6 times the widely defined public debt that it was when it went to the IMF in the 1970s. It's running twice the deficit it was at that stage. Things are unstable. That much I know, and that much I'm comfortable to say. When it breaks, I don't know. It's a really difficult question, and you can see the effect it has on the people who run the IMF. Any more? Can we scratch one more question out of the audience? Yes, right at the back.
You were saying about rising interest rates being bad for the loan market. That seems to run contrary to what the general sort of consensus is, that it would actually bring back the loan market for the floating rate instruments would be sort of more a priority than fixed rate.
You're right to pick at the single statement that high interest rates are bad for the loan industry is obviously wrong. However, it's certainly bad if rates rise suddenly for the portfolios that you would hold. You would get a really quite serious problem with default and economic activity. Longer term, you would prefer to operate in a, quote, more normal higher rate market. When you can barely measure short-term rates, the debt markets really do struggle. Running a short-term money market fund in the US is a bit tricky nowadays, as the interest doesn't cover the costs. Higher rates will be good for the industry longer term, but in the short term, pain and grief. That's probably a good point to leave. Thank you very much.